In the most popular episode we recorded last year, we revealed to you the silent property crash. The silent property crash impacts us all, yet nobody talks about it. It's possibly the biggest concept in property right now that is impacting everyone's wealth. But if you don't understand what has happened, you cannot take action. So in this week's episode, we update you on the silent property crash, what has happened a year on, and what should you be doing as a property investor.
Yes, welcome to the Property Podcast. Thank you for joining us. In case you don't know, we run a business that buys more than £100 million worth of property per year. You can find out more about that at propertyhub.net/invest. But of course, in doing that, we need to know what's going on in the market. And we spend a lot of time digging into the data. And when we do so, we often find that it runs counter to the narrative you normally hear. So stick around for this episode because it might just change your entire view on the property market.
Plenty to cover this week when we look at news stories. First up, let's just check in on house prices, because when we brought you the market update, Halifax were on their summer holidays, hadn't quite released their data, but we've got it now. Rob, what's really interesting is it's been a strong month, but for me, the most interesting story here is actually how close over the last year it is to Nationwide's data. And you might be listening going, well, of course it's going to be the same. It's house prices. It should be similar. But we've talked in the past, long-time listeners will know this, that it's quite regional, Nationwide and Halifax. Halifax tends to cover a bit more of the north and Nationwide a bit more of the south. Generalisation, but that's the weighting. So in this current market, you'd possibly expect to see Halifax a little stronger on the numbers. Certainly has been in the last month, but the last 12 months, quite similar.
Very similar, 2.1 versus 2.3. Over recent months, the Halifax index has been lagging Nationwide a little. But then this month, it's really made up for it all in one go, a monthly increase of 0.8%, which is a big monthly rise, and that's brought it pretty much back into line. And Rob, they're making all the same noises that Nationwide are in the commentary that go along with this about the base rate cut, how that's positive, and how they think things will move up from here.
They are optimistic, Rob, and we will be talking about property prices in this episode and next week's as well. Next week's is a really good episode that pairs well with this week's. So I won't go into property prices just now because we're going to talk about that a lot in a minute. But one of the things that people are worried about and could put the brakes on all of this is an increase in capital gains tax. And has that happened? No. Or is there a rumour? Yes. And people are worried. Now, we will do our normal public safety announcement, Rob, of do not worry about things that have not happened yet. But everyone will ignore that. So let's talk about capital gains tax.
Yeah, but everyone will ignore it. Let's fuel that fire. The average landlord will be £11,000 worse off, according to some research, which I assume is based off the average price gain when people sell and the difference between what CGT is charged at now, which is 24% for higher rate taxpayers, and what it could be, which is aligned with income tax, which could of course be up to 40 or 45%. So this is all over the news at the moment. I think a large part of that might be because Parliament isn't sitting, there isn't anything actually happening, so all you can do is speculate about what might happen. We won't find out until the 30th of October, which is the budget, whether this will happen or not. I think people get very emotional about tax. I've noticed people getting emotional about capital gains tax in particular, because we've had a lot of people calling in, writing in over the last couple of years when their properties have stopped performing so well and saying, oh, well, I would sell, but capital gains tax. Like, well, yeah, but you knew there'd be capital gains tax, right? That's not a surprise. We've already had the basic rate allowance cut significantly, which has increased the rate that people pay. And if the rate it's charged at goes up, then of course that increases it again. And of course, you'd rather it didn't happen. But there are ways around it. There are ways to deal with it. I personally struggle to get too upset about all this speculation, but based on what we've seen over the last couple of years, I do think it will change people's behaviour if it happens and make people even less inclined to sell than they were before.
Well, people get emotional about a lot of things these days, Rob, but the capital gains tax, I can get it if you just follow the headlines, but this is part of our mission on the Property Podcast, is to get beyond the headlines. Because for property investors, an increase I don't actually think is that bad, which may sound daft. You go, Rob, more tax, that's got to be bad. How can you spin this? I'm not trying to spin it. What I'm saying is, as property investors, there's things you can do to adapt and the strategies you can deploy. Yes, you have to do things in a slightly different way, but you have options, unlike some other asset classes. Overall, I'm not a fan of this, and I've kind of made that clear already. I think it's bad for the economy because, yes, you will raise more tax in the short to medium term, but you will drive away some of the people that you want in this country, the people who would pay the most tax. So I'm not personally a fan of it for the country's sake. However, it's just a rumour at the moment. But if the rumour comes true, we will coach you, we will train you, we will educate you on what you can do differently as a property investor so it doesn't hurt so much. Luckily, with property, there is so much flexibility and there's so many different ways to approach property investment. So we will guide you through that, tell you what we'll be doing as we move forward so you can replicate it and do it yourself. But do not do anything drastic now. Unless you were planning to sell anyway, don't suddenly start liquidating your portfolio in anticipation that it's going to all go up after October 30th. Chances are you wouldn't get it all sold in that time. And if you wanted it to all complete before then, you'd probably have to knock loads of money off anyway. So don't start doing anything daft. Also, on the flip side, if you were going to invest and then now you're thinking, oh, I won't, well, what asset class are you going to buy that doesn't have capital gains? You're going to struggle. So you should carry on because the tax may change, but in 5 years could change again. And in 10 years could change again. And it could get worse, could get better. You don't plan on the immediate tax system. Just keep investing for the long term and you'll be all right overall. But to give you reassurance, we will give you guidance on what to do if this happens. In July last year, we declared the property market to have crashed. A silent property crash, which seemed bizarre because everyone else said the property market was going up and it was going up great guns, but it hadn't. It had crashed. And we proved the concept to you by using data and we shared that belief with you. We got so many comments. We had so many people reach out to us after that episode, just shocked at what the data revealed. So a year on, we wanted to look at what has happened since. Is the market now in recovery? Is the crash over? Or has it continued? And what does it mean for you as a property investor? What action should you be taking off the back of this information? Rob, I can't wait to get into this episode. But before we do, just in case anyone missed that episode, it's worth giving a quick recap of what the silent property crash is.
Definitely, because I think some people will be listening going, what the hell are you talking about? Property unaffordable, it's more expensive than ever before. And on the face of it, that is true. The current average property price, according to Nationwide, is £266,000, which is close to an all-time high, way higher than what prices were when they last crashed around about 2008. Now, a crash was supposed to happen post-COVID. But first, it was meant to happen as a result of COVID, but then the opposite happened. The market went absolutely mental. And as a result of the market having gone mental, prices were supposed to come way, way down from there. In fact, prices peaked in the summer of 2022, but they've fallen less than 3% since then. So people might be thinking, Rob, what are you talking about? Property prices haven't crashed. They've come down less than 3%. That is not a crash. The difference is when you adjust for inflation. And this is known as looking at the nominal price, which is the number of pounds you actually pay for something, versus the real price, which is where you go back and you adjust previous house prices from past years to strip out the impact of inflation. And this is really important to do because there could be two things going on. There could be a property boom. You could have the price of everything else being flat or going up a tiny bit and property going absolutely bonkers, racing ahead of everything. Or you could have inflation lifting the price of everything, including houses, your supermarket shop, your wages, everything else. And which of the two is the case? And Nationwide, whose nominal house price data we just referenced, also produce a data set of property prices in real terms, so inflation adjusted. So this isn't just some numbers that we've cooked up out of nowhere. This is official Nationwide data. I'm emphasizing this isn't just something we've made up, because when we say what this data shows, I think a lot of people aren't going to believe us.
Well, the great thing is it's data. It's not an opinion. So what does the data tell us? Well, that house prices are actually cheaper than 20 years ago. Yes, you heard correctly. 20 years ago, house prices were more expensive than they are today in real terms. And not just by a little bit, by 13%. So house prices today are lower than the middle of 2004 when you adjust for inflation by 13%. That is huge. Absolutely huge. But what about this crash we're talking about? Because that's not really a 20-year crash. We're talking about a crash more recently. So after the COVID mini bubble, where property prices peaked in 2022, Rob, before you said prices had fallen 3%, but not when you adjust for inflation. It's 15.6%. House prices in real terms in the last 2 years have fallen by 15.6%. That, my friends, is a crash. In 2 years, house prices have come down 15.6%. Rob, that's a huge number. We got excited a year ago. In the last year, it's continued because inflation has outstripped property price growth. So the numbers have grown since we reported on this last year. We got excited about it a year ago. Our audience, our community got excited about it a year ago, and no one else has. I thought that this would be the beginning of people to talk about this on an ongoing basis and really assess property in a different way. But people just talk about the same old things. They go the lazy route, maybe the uneducated route, or maybe the non-obvious route, which is just, oh, what's the nominal number? What's the number of house prices? What is it compared to a year ago? But inflation, as your book, The Price of Money, rightly pointed out, is kind of a big deal in our world, and it's a big deal in property. But we don't address that big deal. And the result of inflation is a 15% crash in the last 2 years.
That's right. And you're starting to see comment now about how house prices have bottomed. So the narrative that was still in place at the beginning of the year, that house prices were going to fall over the year and continue to go down somewhat, that seems to have come to an end. A big asset manager called Aberdeen recently upgraded their property forecast, especially residential property. They believe that prices aren't going to go any lower. But the way it's being talked about makes it sound like the crash never happened. So, oh yeah, prices have come down 2-3%, but that's it. In fact, the crash has happened by the time you look at inflation-adjusted prices. And for me, Rob, this is the really important point because it's a very different scenario. If you just look at the pound notes price, you go, well, it didn't go down as a result of this. Clearly, the housing market is insane and house prices are just getting more and more ridiculous, less and less affordable. All we're doing is storing up a bigger and bigger bubble for the future. But when you look at the inflation-adjusted prices, that leads you to a very different conclusion because you go, oh, actually, well, maybe house prices did go a bit bonkers during the COVID years, but they've come down again now. That's over. If you take the 20-year view, they're still lower than they were 20 years ago. So clearly the housing market isn't bonkers. They're not just getting more and more unaffordable. We're not storing up bigger and bigger problems. So it can look like you're splitting hairs by sort of going, oh, yeah, well, if you're just inflation, blah, blah, blah. But it's a really important point.
It's a hugely important point. But actually, and this is an episode for another day, if you look at just nominal house prices and how they've performed, on average, property prices have doubled every 7 to 10 years, depending on what set of data you use and who you listen to. But that's the average. The longest property prices have ever taken to double is 14 years until now. Because from the lows of 2009, property prices still have not doubled. In the first quarter of 2009, property prices were 149,000. Today, the average property price is 265,000, according to Nationwide. We're not even close to doubling. So we are at now 15 years in and property prices haven't doubled. So even if you just look at it in nominal terms, property prices haven't ballooned. In the longest doubling cycle since the Second World War, that is really interesting. And we're going to pick up on that in a future episode. But today, it's all about the silent property crash. And Rob, if you're listening to this, you might be thinking, why on earth am I investing in property? Guys, you've been talking for 10 years about how great property is, and you've just told me prices are lower than they were 20 years ago, and they've crashed 15% in the last 2 years. Nice one, fellas. Well, it's not as simple as that, because something we've talked about on the podcast over and over again is the power of leverage. And Rob, leverage is supercharged with inflation and actually turns this whole scenario all around as a property investor.
That's right. Something we've said many times before is that as a property investor who's using mortgages, inflation is not your enemy. Inflation is actually your friend. So we said property prices are the same now as they were 21 years ago, in the middle of 2003. So you might think, okay, well, you've collected some rental income over that time, but that's not a very exciting investment. But actually, that's not the case. So let's say that you bought the average UK property in the middle of 2003, 21 years ago, for £125,000, which was the average price at the time. To do that, you used a mortgage. So you took out a mortgage for 75% of the purchase price, which is about £94,000, and put down the cash for the rest. As a result of only going up in line with inflation over those 21 years, that property would now be worth £265,000, as we've said. What that means is if you then sold the property today for that price and you paid off the mortgage that you took out, the £31,000 cash that you put in to buy the property in the first place has turned into £171,000, which is an annual return of 8.5%. And yeah, that doesn't include taxes and stamp duty and capital gains tax and all that, but it also doesn't include any rent. That does not take account of rent at all. So purely off the capital growth. And remember, that capital growth is only in line with inflation. No property boom, nothing else. You made an annual return of 8.5%. So I would say, Rob, that property just going up in line with inflation is kind of the ideal scenario, because when you get an actual property boom, you tend to then get a property bust. And if you hold on through that, that doesn't make any difference, but it's all a bit stressful and all the rest of it. If property just goes up in line with inflation, and inflation is moderate, doesn't have to be crazy by any means, you end up making a really spectacular return.
You do, because the rent that's not included in those calculations over the long term matches inflation. Kind of lags it a bit normally, but over the long term, it matches inflation. So what you have is an asset that its rent, that income, that's not included in that annual return, keeps pace roughly with inflation. And then you have inflation eroding the value of your debt. And then even in a market where your property's not outperforming inflation, you're still getting an 8.5% return. But if the market just slightly better than inflation, then those returns go up even further. So we've taken a non-spectacular period of time. We've looked at it and gone, okay, the numbers show a crash. But when you use leverage, it all changes, because debt is also devalued by that same inflation. So that is why it becomes so important. And if you are a cash buyer with property, then maybe you should reconsider. Now, that's not advice, because everyone's at different stages of their life and so on and so forth. But as a general rule, the majority of property investors should be using leverage, because even when you look at a 20-year period of non-growth, you still get annual returns of 8.5% before rent. That's pretty spectacular. So other than making sure you absolutely take advantage of leverage, what else should you be doing as a property investor? Well, hopefully it changes your mindset and that you see that there's opportunity, because we've told you in nominal terms that property prices haven't done anything spectacular. But in real terms, property prices are cheaper than they have been. That property prices are significantly less than they were 2 years ago. But nobody looks at it that way. So you are getting more value. Now, the value is exaggerated in some areas and there is less value in other areas. So, for example, in the southeast and London, these numbers do not look anywhere near as good. And London actually is unaffordable compared to any other period in the last 20 years. London is not an affordable city for property. And the southeast, the surrounding areas of London, absolutely the same. But if you go a little bit further, the Midlands, Yorkshire, the Northwest, Scotland, Wales, Northern Ireland, there is more value now than 2 years ago, and there is more value now than 20 years ago. Basically, what we're telling you is there's a lot of upside. We are miles away from a property boom. The commentators may say property's overpriced. They may say property's gone up too much. But the truth is, in real terms, that is not true. Property prices are 15% less in real terms than they were 2 years ago. Take confidence. Ignore that commentary about property prices being overpriced. You are actually in the slowest cycle since the Second World War. And that's not to be deterred, that's to be encouraged, because you don't want a bust. You don't want property prices to collapse. But if property prices are going to collapse, you want it to be done in this way, in a silent property crash way, because it hurts less. Property prices have readjusted, just nobody's noticed. And Rob, that is the best type of crash. Like, if we could do this every cycle, then great. That's amazing. Thank you. It hasn't happened that way, but I'm grateful for it this time around, because most people haven't even noticed.
That's right. A silent crash is the best type of crash. So we alerted everyone to this a year ago. We're updating on it today. What will we be saying in a year's time? Is this silent crash over, or are we still in it? Well, because of the nature of how all the data lags, we can't say. But I think we've probably seen the end of it now, or at least very close to it, because property prices are now going slightly upwards. And inflation, which of course has been the real driver of all of this, has for now fallen back to target and come under control. So the dynamic of the last 2 years has really changed. So I think that 15% peak to trough drop, that's probably about it now. But does that mean we're going to start going into a property boom? That seems unlikely as well. We said recently when we were doing our mid-year update that sentiment can shift very quickly, but sentiment is so far away from that at the moment, it's just hard to imagine. So for me, Rob, the most likely scenario from here, if we're talking about this in a year's time, is inflation that's gone up a bit and property prices that have gone up in line with that, or maybe a bit more, which, as you've said, as an investor, is pretty much the ideal scenario. So if you haven't encountered this topic before, probably some surprises in this episode. But if you'd like to dive deeper into any of this, check out the show notes because we'll link you to a few other relevant episodes that we've done in the past and also a YouTube video we've done on the same topic. So do check those out if you'd like to go deeper.
So it's time for Hub Extra, the part of the show where we give you more. We give you more each Friday in your inbox through Property Pulse. Check that out, propertyhub.net/pulse. But we also give you more here on this podcast. And this week I want to recommend a sport to you. So I'm in a few business groups. In one of the business groups I'm in, there's also a business owner of a paddle club. And the paddle club is called Padium. You can check it out. It's in Canary Wharf. Small world. Turns out, Rob, you've used that venue, so that's cool. But I then, after hearing all about it, wanted to try paddle because, Rob, you hadn't told me you picked it up, which is very unkind. You didn't share the wonderful sport that is paddle because it's awesome. It's really, really cool. I'd highly recommend anyone to check it out. It's really easy to pick up. It's a very accessible sport. I don't know if others would describe it like this, but I see it as a cross between badminton and tennis. Badminton being a lot easier than tennis, and you use that sort of strategy like you do in badminton where you kind of make people work and put it in corners and things like that. But obviously it looks a bit more like tennis. I'm probably not doing it justice, but I promise you, it's awesome. It's apparently one of the fastest growing, if not the fastest growing sport in the world. So I'm not exactly early on this, but I highly recommend you check it out. If you're looking for a new sport, if you're looking for something social, then check out paddle because it's really, really sociable. There's loads of apps. It's very technology led and it encourages people to just turn up and play with other people. And you get your skill level ranked super easy. I promise you, just check it out. Find your local paddle club, go along, get hold of the app that club recommends, and you will have a new fun sport that's super social. It's great. So social, in fact, there was a podcast listener when I turned up, Rob, on court. And if I remember correctly, his name's Adam, so hello, Adam. But I've loved it, Rob, and I know you've enjoyed it because you picked it up recently as well.
Yeah, it's really fun. I'm not particularly good at racket sports by any stretch of the imagination, and so I'm not great at paddle. But the difference with tennis is, in tennis, if you can't serve, you've got problems. If you just turn up and you randomly play against someone and they've got a really good serve, then you can't return it, and that's the end of the point. Whereas with paddle, because it's more like squash, it brings the walls into play, and serving is not a big deal. It's far easier to have a game and just have a knockabout, even if you've never played before. So I do strongly recommend it. It's a really big deal in Europe. It's still early here, but it is popping up in more and more places. So well worth seeing if there are any courts near you. Well, that's us done for this episode. Hope you found it interesting. I find it fascinating when we dig beneath the headline stats, and so we'll be doing more of that in the future. And of course, we will see you back here next week with another episode of the Property Podcast. Until then, have a great week. Bye-bye.
Bye-bye.